Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Iman Brivanlou. He's the head of income equities at TCW to discuss opportunities in niche areas of the real estate and financial sectors. It's great to have you, Iman. Welcome to Trade Talks.
Thank you very much, Jill. Thanks for having me.
You got it. Market volatility, particularly in real estate and financials, has created pockets of opportunity that you find attractive. Why does it take in-depth fundamental research to successfully select winners from losers?
Yeah, that's a good question, Jill. Here we are again. It seems like, not too long ago, we're dealing with the same thing, bank runs, bank failures, equity and bondholders getting wiped out, brings back memories of the financial crisis, indiscriminate selling. And as you mentioned, oftentimes there are opportunities. What you find is that the quality companies that can survive, the downturn end up being very good stocks for the long run. So it takes in-depth fundamental research to really confirm and validate whether the company is going to be one of the survivors, one of the high-quality companies that's going to make it through. So what we look for are essentially three things: balance sheet quality, secured funding lines. We want to make sure that the quality of the assets that the companies are holding are appropriate for the amount of leverage that they have. We mark the assets to market, make sure that they're not already insolvent, as in the case in some of the regional banks. And we look at the liabilities. Is the debt maturity schedule staggered? Do they have a lump sum kind of coming due sometime in the near term that they might not be able to roll over or refi? And then if they do refi, what is the cost of financing and how is that going to impact the company? And we also look for demand inelasticity as we go into a recession here. It's important to have confidence in the company's pricing power. So, is the company able to pass through increased costs, to consumers as things become more difficult, or are they going to struggle, in doing so? So the last thing we look for is experienced and engaged management teams, ideally those that have some experience navigating past cycles.
What looks attractive in the REIT space, and what are you avoiding?
Yeah, the REIT space is particularly interesting. So here's a space that's been battered down about 3% year to date, down about 20% over the last 12 months. So, perfect example of a situation where perhaps, indiscriminate selling has caused, some of the babies to be thrown out with the bathwater. So within REITs, we like towers. Towers benefit from a long-term secular growth story, as the proliferation of these handheld devices and increased data consumption drives the need for occupancy. They typically do well during recessions. There is visible demand, which results in pricing power. And recently discounted valuations, we think provide for meaningful upside, from current levels. We also like residential, especially in suburban or peripheral locations. You can think of the Sun Belt also as a geographic region that we're focusing on. All of these benefit from positive demographics, population growth, again, leading to sustainable demand and some level of certainty around pricing power. Also, recently rising interest rates has kind of skewed the rent-buy decision more in favor of the rent side of the equation. So current valuations to us look pretty compelling. What we would avoid is the office space. So here's a space that's actually facing severe headwinds from, a secular decline story. The persistence of work from home models is going to probably result in oversupply, as are advances in technology. Just the fact that we're Zooming or, the ability to dial in remotely brings in some degree of obsolescence risk, we think, for the space. So largely undifferentiated product, results in no pricing power and particularly vulnerable, during a period of downturn or a recession. And we would also avoid lower mid-quality retail. Probably most people know that the U.S. is clearly over-retailed. Seems like every corner in the suburbs has a strip shopping center. We think that anything but the highest quality is going to end up being a victim in the long run. So it's going to be a winner-take-all situation, and we'd avoid anything but really the best, highest quality assets.
What niche part of the financials stand out to you?
There is one area that we really like, the BDCs. So BDCs stand for business development companies. They're essentially specialty lenders to U.S. middle market firms. These are companies that typically have revenues of 10 million to about 500 million or so annually. So their target companies can't directly access the capital markets. They can't issue bonds or kind of, finance themselves that way. It used to be that their source of financing were the US regional banks, but during the financial crisis, the regulations that were imposed on the banks essentially made this type of lending uneconomical, from the bank's vantage. So here is a real segment, a significant part of the US economy that, has limited access to capital, and the BDCs to some extent fulfill that role. When you select the BDC, though, you have to be very careful. They tend to be high dividend payers. And while that sounds good, oftentimes that can also portend trouble. So you really want to invest in only the best quality names, those that have, a demonstrated track record of underwriting.
What risks should investors be aware of when investing in BDCs?
So like I mentioned, the key thing is to look for underwriting discipline. So what you want is a historical track record of value creation. I would look specifically at the underwriting performance during past crises. Did the company go through unscathed? What were the level of losses that they incurred? The thing to be mindful of is that while these entities are not particularly levered, even small losses can accrue and result in pretty meaningful book value erosion. So, we would look for those companies that have a demonstrated track record of value creation through multiple cycles. Then again, quality, tenure, and incentive structure of the management teams really is of paramount importance in looking at this space.
All right, appreciate the insight, Iman. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much, Jill.